Hey everyone, it's Rob Weinberg, and welcome back to the channel, where we help you make sense of the mortgage and real estate markets. If you're new here, make sure to subscribe and hit that notification bell so you never miss an episode. Today we're tackling an important question. How do economic factors affect mortgage rates over time? If you're thinking about buying a home or refinancing a current property, understanding what's driving mortgage rates can save you a lot of money in the long run. So let's break it down. Before we get into how economic factors play a role, let's talk about what mortgage rates actually are. So simply put, a mortgage rate is the interest rate that you pay on your home's loan. And like most things in finance, the interest rates aren't static. They're constantly going up and down and fluctuating based on different economic factors. So why exactly do they change? Well, the reason is that mortgage rates are tied to the overall economy. And when the economy is doing well, rates tend to go up. When the economy is struggling, rates tend to go down. So let's talk about what's behind these fluctuations. One of the biggest influencers of mortgage rates is going to be the Fed, the Federal Reserve. Now, the Fed doesn't directly set mortgage rates, but they control something called the federal funds rate, which is the interest rate that banks charge each other to borrow money overnight. When the Fed raises the federal funds rate, it becomes more expensive for banks to borrow money. And guess what? That cost, that higher cost, gets passed on to you as a consumer in the form of higher mortgage rates. So if you hear news about the Fed raising rates, you can expect mortgage rates will follow. On the other hand, when Fed lowers interest rates to stimulate the economy like they did during economic downturns, mortgage rates tend to fall, making it cheaper to borrow money to buy or finance a home. Another big factor is inflation. Inflation is what measures how much prices are rising across the economy. And when inflation's high, the value of money decreases. Lenders want to protect themselves from losing power, purchasing power on their investment. So to compensate for the inflation, they raise mortgage rates. This ensures that banks are still making a profit even as the value of money declines. So if inflation's on the rise, you're probably going to see mortgage rates go up. And when inflation is low, lenders don't feel as much pressure. They can afford to offer lower interest rates. And that's why periods of low inflation often result in lower mortgage rates. Let's talk about economic growth. When the economy is growing, people have more jobs and consumer confidence is high. So in these type of times, demand for homes rises because people feel more secure in their personal financial situation. When demand for home goes up, mortgage rates generally rise because of supply and demand. More people are looking for loans. But on the flip side, when we're in a slowdown or a recession, fewer people are looking to buy homes. So to encourage borrowing, you'll see interest rates will be lower to make home buying more attractive. We also can't forget about the impact of global economic events and global market sentiment. There's things going on like trade wars, political instability, and pandemics create a lot of uncertainty. And when investors get nervous, they move their money into safer investments like government bonds, which tend to push mortgage rates down over time. And a great example of this is what we saw happen during the COVID-19 pandemic. There was so much uncertainty, and it led to a significant, historical drop in mortgage rates as investors sought safety. Even when the U.S. economy is stable, these different global events can have an effect on our rates. Another factor is supply and demand in the housing market itself. When there's a lot of demand for homes, but not a lot of supply, mortgage rates might rise because lenders know people are eager to buy. We're seeing that here in 2022, 23, and 24. But when there's more properties for sale and less buyers, then you'll see the rates fluctuate for that. So what else affects rates over time? Not much. We really covered it all. Inflation, economic growth, global events, market sentiment. There's a lot of moving parts. But the key takeaway is that mortgage rates don't exist in a vacuum. They reflect the overall state of the economy. So if you're planning to buy a home or refinance, you want to keep an eye on these factors or have a team that's keeping an eye on it for you, because timing your mortgage application right could save you thousands of dollars. I appreciate you watching. If you found the video helpful, give it a thumbs up and subscribe for more content on navigating your homeownership journey. As always, feel free to reach out to me if you have questions or need personalized advice, and we'll see you on the next episode.